Welcome to the Startup Grind.
Thanks for having me. I'm happy to be here and get an opportunity to. I wasn't sure whether anybody was going to show up.
Bring a pretty good crowd. So I had the opportunity to sit down with Milt last week, and we started to dive into all of his experience, so I could start to shape what we're going to talk about. And in all honesty, if we were to go into everything impressive that he's done that could be really impactful for the audience, we would be here for 3 hours. So my goal is to quickly go through your introduction, quickly go through like the highlights of your career, and then focus the majority of this talk on how we can apply your experience to help people who are growing companies today. So with that, let's start by asking, where did you grow up?
I grew up in northern New Jersey. Went to school in northern New Jersey, state school in New Jersey, and when I got out of undergrad school, I went to work for PricewaterhouseCoopers, Coopers and Lybrand at the time, so I'm dating myself back when it was Coopers and Lybrand. Spent some time at Coopers, at PwC, and then found my way to Boston. I was working for a company that had a research lab up in Massachusetts, and I got an opportunity to relocate to Massachusetts, and really just at the time, this was in the early 80s, 1981, and got involved in the technology community, what was going on up there at the time, which was pretty exciting, and that was just the beginning of it. So I spent 25 plus years in the software business, in the technology business up in Boston, before getting recruited down here.
I want to bring it way back for 1 second.
Okay.
So you're a kid growing up in New Jersey.
Yeah.
If we were to ask you at like your junior in high school, so like 16, 17,
Yeah.
what are you going to do after college? What would have been
I
your
wanted
answer?
to pitch for the New York Yankees.
Yes.
I played baseball in high school, all growing up and everything. So, but short of that not being a legitimate opportunity for me.
Yeah.
What did I want to do? I mean, I really wasn't sure. Okay. I mean, I think once I got to college and started to really kind of see what it was going to be like. I mean, I think business was just attractive to me, and how I ultimately found my way into a CFO opportunity in many companies that I've worked for in the past throughout my career. I don't know, it just kind of happened. Okay, it was just an aspect of the business that I thought was interesting, and particularly with regards to technology companies, software companies, startups, and so forth. I think the role of a CFO was really in those type-sized companies, and even as you become a public company and a much larger company, the role of a CFO is almost I think, and obviously I have a bias, but I think it's a special kind of a partnership relationship with a CEO and a board, where you've got to understand all of the aspects of the business, or at least be fluent in the other aspects of the business, and be able to provide sort of a, does this make sense kind of thing? A CEO looks at you and says, is what you just heard from the guy that's running sales or the guy that's running development, does it make sense? Does it sound right?
Yeah.
From a business perspective? And so I've always kind of approached the CFO roles that I've had in that vein, okay, trying to be a business partner to my CEO and even to my board of directors.
When you were at PwC, and you were going through the ranks there, was CFO on your mind? Were you in the accounting track?
I was on the audit side. I think, I don't know if CFO, I mean, I think there came a time, and I spent about a little more than 4 years at PwC, and there just came a time when it was, as you might know, I mean, the track to a partnership opportunity at a big four firm now, a big 8 firm when I was there. It was, there's a lot of work, and I think there was a lot of opportunity outside of it. Okay? Yeah. And so, as I say, I ultimately left PwC and started doing financial special project work for a company in New York by the name of Gulf and Western Industries, which is a big multinational conglomerate at the time. And that's how I found my way to Massachusetts, through that opportunity with the research lab that I have in Massachusetts.
Yeah. How did that lead you to? Was ePrize your first CFO role? Or did you have one before that?
ePrize was my first CFO role.
Okay.
Yeah.
What led you? How did you make your way?
I kind of worked for a few other technology companies in Massachusetts when I first got there. There was a company called Applicon, which was a CAD/CAM company at the time. And then I found my way to an artificial intelligence company by the name of AI Corp. Kind of became the corporate controller and VP of finance there, and then ultimately found my way to ePrize, which at the time was a startup, a little more than startup. They had raised an A round of financing. The individual who started ePrize actually started it as a gaming company, and actually to this day still has another gaming company that's pretty successful up in the Boston area. But ePrize was a website content management company, and I joined ePrize in early 1998. ePrize had raised an A round of financing, and when they brought me on board as the CFO, really what they were looking for was to put the business plan together to raise a B round, to raise another round of financing, more for sales and marketing type of resources and whatnot. And so we did that and went out and raised a B round of financing. We then added to our board of directors, after we had raised our B round, a fellow named Ed DeCastro. And Ed DeCastro was actually the founder of Data General. There's a book that was written about him back in the 80s called Soul of the New Machine, and the rise of DG as one of the big computer companies in Boston. And Ed DeCastro became our chairman, and we then went out looking for a C round of financing, a third round of venture financing, but at the same time we're thinking about going public, and we're starting to interview investment banks.
What year is this?
This is 1998, 1999 time.
Okay.
Late 1998. We figured that B round would last us about a year, which it did, and then we started to talk about that C round. And we were interviewing investment banks as well as for somebody to take us public, presumably, whatever, a year or so beyond that. And Deutsche Bank was a bank that we had met with, and they actually talked us into using them to not raise a C round of venture financing, but just do a private round. And so we went out in 1999, raised a private round, very, very successful, and then came off the road from that private round, and Ed DeCastro, our chairman, basically said, let's just get ready to go public now. This was like November of '99. We thought we'd go public maybe in the second or third quarter of 2000, late 2000. It was like, let's just do it now, turn around. It was very prophetic at the time with hindsight, but we started preparing for an IPO and actually took the company public in March of 2000.
What were the market conditions at that time?
I mean, that was the bubble, okay? And there's nothing like that. I mean, many of you obviously, based on your faces and your ages, I think, didn't live through the bubble. But it was crazy, but it was normal at the time. I mean, everybody thought it was normal. And just to give you the brief ePrize example, we basically, our revenues for the year ended 1999 were less than $25 million. Revenue was less than $25 million. And that was pretty good.
Profitable?
No, profitability was a gleam. It wasn't even a gleam in somebody's eye. Okay, and so we went out and began to think about doing a public offering. And at that time, it was much more open as to like which companies were out filing or thinking about filing for public offerings and whatnot. And so anybody that was interested in buying your company at that time, they kind of came out of the woodwork. We had a few companies that were interested in ePrize, and in January of 2000. The company that was probably the most serious about buying us at the time was Macromedia, okay? And Macromedia, we went out to California and San Francisco, met with Macromedia, they came to Boston, and keep in mind, $25 million of revenue for the year ended 1999, and in January of 2000, Macromedia offered us over $500 million for ePrize. And we said, no, we don't think so.
We're good.
We're good. Okay, not enough. And I got it wasn't like, me, some first-time CFO, but I got Ed DeCastro, the guy that founded Data General with us, okay? And we ultimately then, they didn't counter. We ultimately then went ahead and filed for our public offering, took the company public on March 24th of 2000. And on the day that we went effective, our market cap was over $700 million. And less than 90 days later, we had $25 million. 90 days prior, we had $25 million of revenue. So it's crazy. Okay, now then the rest is somewhat history. Okay, 6, 8, 9 months later, the market tanks. Things kind of implode.
Let me ask you a question. You're the CFO.
Yeah.
If anyone in these companies going through the bubble should have like warning signs going off in the back of their head that this is insane, I would think it would be the person in that role. What's going through your mind when it's all happening?
I guess. I mean, everybody's working their calculator.
Yeah, I mean, everyone's doing it.
But I mean, I think that really what people were, it was kind of the way things were. I mean, valuations were predicated on who was the last company in your space that went public. They weren't based upon multiples of revenue or multiples of profitability were still negative numbers.
Yeah.
It was kind of the norm, if you can call it that. And then when the market finally fell apart and things kind of, there were people obviously who were saying, there were the pessimists, okay, who were thinking accurately that the bubble was going to burst. Yeah. But it did. And, we, after the bubble burst in, kind of mid to third quarter of 2000 or so, we still grew the company and ultimately wound up selling it for not $700 million.
What was that when it burst? How did that affect?
Oh, our stock price, like, probably, we were in the single digit,
What was that like?
Sub-5.
Being at a company that overnight you lose.
But there were a lot of companies that were in that position. I mean,
Yeah.
because everybody was going public. I mean, that was kind of the way to go. And so public offerings, there were websites that were categorizing companies that were going to file for public offerings and whether they were ranked as hot, red hot, white hot. I mean, it was crazy. So.
What's the CEO thinking? Like, he shows up that day, our stock price is cut into, like.
He was, the guy who was the CEO of ePrize, who technically came in maybe about 9 months or maybe a year before I joined ePrize, was a guy out of Lotus. Okay, he actually worked with DeCastro at DG and then actually came in out of Lotus to take the CEO job. And it was his first CEO gig, okay, as well. So we were kind of in this together, okay. And it was like an okay, I say an okay outcome. I mean, it is what it is. I mean, we continued to grow the company, obviously at a much slower pace, and ended up selling it for, like I say, a lot less than $700 million.
So what was your total tenure there?
I was at ePrize until 2003.
Okay, so 90 to 2003, let's sum it up. You said there was 25 million in revenue when you got there,
Yeah.
peaked at 700 million valuation.
Right.
And it sold for?
It was sub 200 million.
Sub 200 million.
Sub 200 million.
It's a hell of a 5-year ride.
Well, yeah, but I mean, considering where you came from.
Yeah, absolutely. So that winds down. What's like the one lesson that you learned from that experience that changed the way you approach
Well,
like
it's
the next
sober.
role?
It's sober.
Yeah.
Okay? So I think everything changed. Okay, and I think really what changed was the fact that nobody really, I don't want to say cared about, but cash flow, profitability, that wasn't anything. It was all about growth.
Right.
Okay, and how fast you could grow, and money was abundant. So I think what happened after the bubble burst was obviously there became a very, very harsh realization that obviously this isn't the way to do business, and I think that began, what even today is still, going on. The realization that you really need to, if you're going to start a company and you want to grow that company, you really start to think early about a path to profitability, a path to generating positive cash flow. I mean, investors today are still, these people aren't stupid. I mean, they understand that you need to invest in your company and you need to make investments in a lot of different areas in order to grow your company. But you do have to continue to think about and develop plans and be able to articulate what your path to profitability is. When are you going to get there? What do you think your revenue levels need to be? What's your addressable market? How much of the addressable market do you think you can garner in what period of time, and what that's going to do for profitability and cash flow? So that was the beginning.
Yeah.
The bursting of the bubble in the 2000 and call it 2001 time frame was the beginning of, I think, this complete change that sort of as we kind of go through the 2001 to the current time, it sort of has kind of a bubble has started to come, okay, and then actually changed. Even in the time that I was here, I've been here in Charleston with Benefit Focus.
Sure.
There was a bubble building, and then I think there was some realization that, particularly for companies that are as a service, whether you're software as a service, platform as a service, something as a service, I think there was a time when revenue growth became pretty important, and then Janet Yellen, frankly, made some comments that sobered everybody up and said, no, it's profitability that we need to think about.
I hear you there. And I know we talked a little bit, and you went from ePrize to Apex, am I saying that right?
Apex, yeah.
And you did a really good job growing profitability, or revenue there.
Yeah.
I won't say profitability because I don't know, but talk a little bit about what that experience
Yeah,
was like.
Apex was a company that I joined in 2003. It was a company that was founded back in the mid-'80s. It was a public company when I got there. And lovingly, I guess I'll say, I call it a shitty little company when I got there. I mean, it was a public company that had a market cap of about $35 million, a market cap of $35 million. A friend of mine that I was on the board at Apex, and everybody knew Apex when they were founded in the mid-'80s as a CRM company. They were trying to compete with the Siebels and those type of CRM companies. And they had a bit of a heyday at the time, and then got kind of washed over, okay, by Siebel and other companies that were doing CRM at the time. And then Applix sold off its CRM business, okay? And it sold off its CRM business. The board terminated the then current CEO of the company. And this person that I knew who was on the board of directors there called me, and he basically kind of took the CEO role, okay? And he was a, kind of a serial entrepreneur. He founded a company back in the 80s called Banyan Vines that competed with, or Banyan that competed with Novell, okay, in the networking space. And he called me and he said, hey, so this is what we just did at Applix, and what we're left with here is an analytics product offering, kind of a business intelligence, people called it business intelligence or business performance management at the time. And it's small. I mean, we got, maybe, I think maybe $15 million of revenue. That's all we're left with. People still think we're a CRM company. We're still a public company, okay? So they're still going through all their public compliance requirements, but none of the analysts knew them, covered them. It was kind of it was a shitty little company.
Yeah.
He called me and he said, hey, I need a CFO because I'm going to fire the CFO. So I need somebody to come in. He goes, this will probably be about a 12 to 18 month gig, and we're just going to polish it up and then probably sell off the analytics business. In 12 months, 18 months will be done. And so I said, I can do that. Okay. I said, yeah, and I like this guy, and I'd known each other for a while. And so I came in, and the interesting thing about Applix was it had a great product. Okay, they had a product that was called TM1. Okay, it was a OLAP engine, multi-dimensional cube structure. Okay, for planning primarily used for planning and analysis, financial planning and analysis. And it had a cultish customer base. Okay, the customers that were using TM1 loved it, and it also had an interesting partner community as well. And so we kind of started to do our thing, and as we were doing our thing, just kind of getting the company kind of back on its feet after having sold off the CRM business. Another thing that I failed to mention was that the CEO, the guy who came off the board, told me when I was joining, he said, oh yeah, another thing, he says, we're under investigation by the SEC.
Oh, by the way.
Yeah, and so there's some revenue recognition issues here that we need to clean up as well. I said, okay. And so we started to work on everything, okay, the infrastructure, the SEC investigation. Ultimately, with hindsight, took me over 2 years to actually settle that SEC investigation. But as we started to get into it, we found that this product and the customer base, okay, and the partner community was really very loyal, and it was interesting. We started to grow the company, and we brought on board a guy out of Cognos to be ultimately our chief operating officer. And what was supposed to be a 12 to 18 month gig where we would just sell off the analytics business, 3.5 years later, we sold the company to Cognos for $340 million.
What were the revenues at that time?
Our revenues were in the, they were about 70, 75 million.
Profitable?
Okay. Profitable, yeah, we were profitable. And it was, Cognos, it was interesting because at the time, the three companies that really made up the community of what was business intelligence or business performance management were Cognos, Hyperion, and Business Objects. And we were literally talking to all three of them at the same time about acquiring Applix. And then Hyperion got picked off by Oracle, Business Objects got picked off by SAP, and Cognos was left. And Cognos was actually the best partner for Applix for a variety of reasons. But they ended up buying Applix for $340 million. And then I was going to stay I think they wanted me to stick around for 6 or 8 months or something. And right after the acquisition of Applix by Cognos, IBM approached Cognos and wanted to acquire Cognos. And so I started to work with the CFO of Cognos on that acquisition, helping him. And then I actually left Applix/Cognos the day before the IBM transaction closed.
Are you in the room for these negotiations?
I mean, it's obviously very much so for the Applix/Cognos transaction.
Right.
Okay, that was myself and the CEO and our board. Okay,
Yeah.
which is essentially made up of venture partners and things like
What are
that.
some things you and the CEO are talking about? So you're getting offers from billion-dollar companies. You've built a pretty successful company. Like, you leave the room, you get in the cab. Like, what do you?
We're like, holy shit. 500 million, and we're sitting there going like, no. and the reality of it was is that literally at that time, it wasn't as kind of confidential today before companies file. Back then it was like if you were going to file in 2, 3, 4, 5 months, it was public information. Okay, and so that's why I say it draws out companies that were interested in acquiring you. So you were effectively using the public market as like a stalking horse to compete with. And we knew that when Macromedia offered us, in the E-Prize case, when Macromedia offered us that kind of money, we knew that when we went public, we'd have a market cap more than that. So, but little did we know the market was going to tank and the bubble was going to burst. In the Applix case, we did a good job. I mean, I was very proud. Very proud of what we did at Applix to get it to the point where, Cognos was willing to pay $340 million for it, and it was the notion of getting your company acquired, you're going to get the best valuation from when it's a strategic purchase, when it's more than, it's not just a private equity, buy, or, investors that aren't really invested, if you will, no pun intended, in what you're doing in the space that you're operating in and what your product can do. And so I think Cognos was a tremendous partner. And
talk about how they were different than the other two offers you had. Why did you latch on?
We didn't have any offers.
I thought you said there was three.
Well, we were negotiating, but then Hyperion got acquired by Oracle, and Business Objects got acquired by SAP. So we didn't have. We thought we would have three competing offers, which would have been nice. Okay, but we weren't disappointed by the price that Cognos paid for Applix. And I think it was a great win. And I can honestly say, like I say, Cognos then was acquired by IBM, and to this day, that TM1 product is a piece of core functionality and technology in IBM's FP&A offering, their financial planning and analysis tools offering.
Okay. So do you have an off button? What are you thinking now? You did what you set out to do at this job.
That was and then
probably in a good place. What's in your head?
So then I actually wanted to kind of go back to a privately held company, okay, and I kind of knew the people in the venture community in Boston, and I kind of sent out some feelers and talked to a few of them, and I got a call from the guy that did talent acquisition at Battery Ventures, which is a big Boston-based, international but Boston-based venture capitals. And he called me and he said, "Hey, I got an opportunity for you. It's with a privately held company here in Cambridge. They're a little bit." I was thinking I wanted to go to a company that was maybe looking for a B round of financing again. So they said it's a little bit bigger than what you're thinking. ITA at the time, this was a company called ITA Software. ITA was about $70-ish million at the time, something like that.
What was appealing for you to go there?
It was a really interesting company. What ITA did was we developed a software platform for airfare pricing and shopping. And so any major North American airlines and any online travel site other than Expedia, but Orbitz, Kayak, Travelocity, all of them at the time, as well as the old major airlines, used our platform. So if you went to any of those websites and said, "I want to go from here to there on this day with this many people," we would basically provide you with the airfare. Okay, so we would shop the inventory, and the algorithms behind this product were pretty sophisticated. The guy who was the founder and CEO of the company was a guy by the name of Jeremy Wertheimer, who was a double PhD out of MIT, and we hired MIT people. He had to be able to look out the window and see the dome. So it was kind of, but there's a lot of incredibly smart people. And one of the things, and the business was very profitable. Okay, it was a SaaS model. Okay, and it was very profitable. And one of the things that they set out to do was they then raised, before I got there in 2008, and they raised some venture capital in 2007. Okay. They raised about $100 million of venture capital, and that's where Battery got involved. Okay, Battery and General Catalyst and Spectrum Equity were the big venture funds.
What round was that?
It was a first round. They had never, everything else was like funded themselves, and they just, generated a bunch of cash.
Yeah, talk to us, that's pretty rare, $100 million first round. So what does the business do right to put themselves in that position?
Well, I think what they were trying to do, and what the product offering that Jeremy and his team were trying to develop then, was we're going to take the venture money and we're going to build a new reservation system for the airline industry. So the reservation system, that even today that's existing, it was developed in the 1960s. Okay, Sabre. There's also a company called Amadeus. Okay, which is more international than here in the States. But these are the big reservation systems. Okay, that green screen terminals, hieroglyphic type codes, and so forth. And what Jeremy and his team wanted to do was raise this money so that they could invest and build a new reservation system. And they raised all this money, and I got there about a year later. They'd never had a CFO before, but the venture capitalists now say, you need to see it.
100 million in the
You
bank.
want 100 million.
Obviously, they didn't need it.
Yeah.
And it's interesting because really they didn't. So when I got there, the money was still in the bank, okay? And they were still building a reservation system and funding it with the cash flow from the pricing and shop from the QPX product line.
Yeah.
And I had lots of conversations with the board and with our CEO about, trying to do something to use this. I mean, it's just your venture money, okay? And I'm talking to the board saying, you guys put this money in the company and it's not being used. It's just sitting there, okay? And they, we talked about it and they were moving forward, building the reservation system. And it was very demonstrable. It was a real product offering. It was hard to get a major airline to accept it because if it, their mentality for what they called above-the-wing systems, okay, which included things like reservations and pricing and shopping and those type of things, as opposed to maintenance and whatnot, which they call below-the-wing systems. It was pricing and shopping was great, but reservations, that was the core above-the-wing system. And it was like, we really like your product, we really think it's great.
Yeah.
We'll be the number 2 airline to buy it.
Right.
So as soon as you get and we had, for our pricing and shopping engine, we had all the major airlines at the time. So you had United, American, Delta, US Air, all these were customers of ours. And we talked to all of them about it, and they were like, love it, but geez, no. And they would literally pay, I don't know, hundreds of millions, but a lot of money to the big, like IBM Global Services or HP to maintain these systems that were built in the 1960s.
Yeah.
So anyway, we kind of started to talk to some smaller airlines, and then what happened with ITA was in December of 2009, I got a call from Google. And Google, before I had got to ITA, Google had looked at the ITA before I'd gotten there and it passed, okay? And then they contacted me in December of 2009 and said, I want to take another look. And so they do what they say what they do. They're very, they move very fast. I mean, they've got a corporate development organization that will rival many investment banks.
What are they interested in? Why do they want travel?
Google told us when they were talking to us, that they said that 30%, by their estimates, 30% of every search that's done on Google has some element of travel associated with it. Not just necessarily how do I get from here to there, but what's going on in Charleston this weekend? How do I get tickets for this? Where do I stay? I mean, some travel element to it. And, 30% by their estimates at the time, they said it had something to do with travel. So Google wanted it, and they still do today, and they're doing it. I mean, they want to own the travel space. So they want, basically, when you want to do anything, anywhere, they want you to just Google it, not go to any of the other airline sites or online travel sites or whatever. So they contacted me, and they also had, when they were talking to us and said, well, we're also interested in what you're doing with the reservation system, but they really weren't.
Right.
They wanted the pricing and shopping engine, okay, for air travel. And so they, as I say what they do what they say. We started to negotiate with Google.
How was that?
It was very interesting. I mean, they're very nice, they're very smart. They're very, I want to say accommodating, but I don't want to say accommodating because there were 1 or 2 instances during our negotiations, maybe 2 or 3 instances where I wanted something and they just basically said,
Talk about
sorry.
it. What do you remember what one?
One had to do with acceleration of vesting of options for all the employees, okay, and the pricing, and they said, well, we want you to accelerate all the vesting of all the options. And we said, well, the option agreements don't call for that.
Yeah.
And they said, well, and this is Google. I mean, they're the buyer, but they're saying we want you to accelerate vesting of all options for all employees. And I said, fine. I think that's an awesome thing to do. You're going to have to pay for that.
Yeah.
And they said, no, we're not. We're going to pay a fixed amount of money for ITA, and you're going to have to then spread that purchase price across a larger number of outstanding shares. So you have to basically suffer the dilution, if you will. But anyway, but they were tough, but they were very, as I say, they told you what they were going to do. They were very quick to respond to us with a term sheet, and it took us from December of 2009 until I want to say May of 2010 to actually finalize the purchase and sale agreement, the share purchase agreement with Google. And they paid a little over $700 million for ITA. And we had revenues of about $130 million by that time.
Okay.
And so they paid a good price for ITA.
Are you in the room for those?
Oh, yeah.
You, CEO?
Yeah, and our
people.
board, okay, and so we negotiated with them, and then as you would expect at the time, even maybe more so than today, Google had a target on its back from the government. So immediately you have to go through the government, the Hart-Scott-Rodino and all the kind of reviews. And, it took us from May of 2010 until April of 2011 to get the Justice Department to approve our transaction. So it was almost 11 months where we were negotiating, I guess, with the Justice Department. Our chief operating officer at the company, who was very well known in the travel space, was down in Washington at least once a month. And I was down there 3 or 4 times with our CEO and just kind of talking to and answering questions. And Google was just very, don't sweat it. I mean, they're going to approve it. It's going to happen. Don't worry about it. But there's a very limited amount of things that you can do relative to combining the companies or even planning to combine the companies while this investigation is going on.
Right.
And one of the things that happened was that Kayak, I think you know the Kayak website, Kayak was probably our 3rd or 4th largest customer. And because we basically powered Kayak. So you go to Kayak, and Kayak is essentially a meta searcher. They don't book tickets, okay? So you can just shop for airfares. And then when you find an airfare that you want from US Air or whomever, and you press P to purchase, per se, it just takes you to that airline's website. They don't actually book your tickets. So they were very, very afraid that Google was just going to put them out of business, because Kayak is just a search engine for airfares, using our platform to actually find those airfares. So they created a consortium of some of the online travel sites that included Travelocity and Orbitz, and called faresearch.org, I think it was called. And they lobbied the Justice Department to block the transaction. So that added some time.
Sure.
Google had to make some concessions around the technology and the availability of the technology to those people, okay, before they would approve it. But they approved it, and in April of 2011, we closed the transaction, and we became Googlers.
$700 million richer, and Googlers.
We became Googlers, and that was very interesting. I mean, I think, as you would expect, and certainly when you get to an acquisition like that, the first person that goes is the CFO. Okay? So if there's any CFOs in here, negotiate your contracts appropriately. But anyway, Google had asked me to stay. Most of the company, we had at the time probably 700 people in the company, and I would say probably more than 500 of them were technical people, okay? Real developers or on the periphery, QA people or people who were working with the technology. We had a relatively lean G&A organization, sales organization. But they asked me to stay for a year, okay? They said, we want you to stay at Google for a year and help combine ITA within the Google infrastructure and so forth. And I was like, yeah, I mean, I'd kind of been working with Google for the last year and a half anyway, between the negotiating the agreements and getting to know what Google was about, and then while we were going through the Justice Department review. And so they said, we want you to stay for a year. And I was like, works for me, okay? And they're a machine, okay? So when you're ready to integrate your revenue system, they've got 30 people that'll basically there to help you at your disposal to kind of get you into the Google infrastructure.
What do you think what do you think they do right? So you went through a few acquisitions, you went through the integration process, like they're a machine, but what does that actually mean in execution? What do they do better than others in that area?
I just think they have a lot of resource, and they have a lot of smart people doing it, and so they know exactly when they basically team up for an acquisition. And I want to say at the time that ITA was going to be the 2nd largest acquisition that Google did. Okay, they had acquired a company called DoubleClick about a year or so before that, which was over $1 billion. But I think ITA was about the 2nd largest acquisition at the time that they did, and they subsequently then went out and bought YouTube, and they went out and got, they bought the, when they were making those little, the little shitty devices. Okay, I'm trying to think of what it was, I forget. But I think what they do right is they just basically know what they need, and they are just very efficient at incorporating and integrating everything: the organization, the people, the product, the technology.
Awesome. Well, I want to get to my tactical questions for the startups.
Okay.
I don't want to skip over Benefit Focus because I know it's a big part of your career and why a lot of people in this room know you. So, 2 to 4 minutes. What are the highlights of Benefit Focus? What drew you there? What was your experience like, and what was?
Yeah, so I was finishing out my year at Google, and actually at the time was working for Patrick Pichette, who was the CFO at Google, and doing some work for him. And I was actually back in Boston, and I got a call from a West Coast-based search firm saying that they'd heard about me in Google, and that I was going to be leaving. And they said they had this great East Coast-based CFO opportunity that they thought I would be great for. And do you want to hear about it? And I said no. I said I'm just going to take some time off and just kind of figure it out from there. But they talked me into hearing about it, and after a while, I was like, is it in Boston? I mean, I'm in Boston. And they said, no, almost apologetically. They said, it's in Charleston, South Carolina. And I said, I know Charleston. My family and I vacationed down here for a few summers, so I kind of knew the city as a visitor. And so I said, is it Blackbaud? Because I was the only company I knew in Charleston. And so they said, no, it's this company, Benefit Focus. And just to make a long story short, so I got to know the company, and after a few, at the time it was like, okay, I'll talk to the founders and I'll, look at the opportunity, but what are the chances? I mean, I'm in Boston, the company's in Charleston, the search firm's in San Francisco. And I said, but after a couple of visits down here again and talking to the founders of the company, it was a pretty compelling opportunity. I mean, Benefit Focus is a cool company, okay? It certainly was at the time, and we've grown considerably. It still is a very cool company. And they wanted to take the company public in like 12 to 18 months at that time. And the two founders of the company, Sean Jenkins and Mason Holland, who are our CEO and our chairman, respectively. This is like a first-time thing for them, okay? And they're smart guys, they're self-made guys, they know what they don't know, they know what they do know. They did a great job growing Benefit Focus to the point that it was at that time. And they want to take the company public, and they needed a CFO, okay? And so I think the mutual attraction was, at the time, Benefit Focus was an interesting opportunity, and the notion of then taking another company public was something that was kind of, I think I'd like to do that again. And it doesn't suck to live in Charleston, as you all know. And so I was saying, like, once the opportunity became mine to lose, there was a decision to make as to whether I really wanted to move down here, which was, I think it was great. Okay, I'm going. Okay, I'm going to go to Charleston. And so I came down here, and we talked about taking the company public. That was in January of 2012 when I actually started working for Benefit Focus. I completed my physical move down to Charleston in August of 2012. And we immediately started talking about the timing for a public offering. The largest investor in Benefit Focus, and even to this day, they still are, although they own a much smaller percentage, was Goldman Sachs, the private equity people at Goldman Sachs. And so when we talked about going public, there was no discussion about who was going to be the lead manager in the IPO. But we immediately started talking about building an infrastructure to take the company public. So that meant, choosing a banking team. It meant getting some investor relations resources, which took me a while to convince Sean a year before we went public to actually bring on some investor relations resources to help me kind of get the company prepped for that. And we had a tremendously successful IPO in September of 2013. It was great. We were one of the few stocks in 2013, literally, that our stock price doubled on the first day. It increased by more than 100% on the first day of trading. And it was great. It was a terrific IPO, and it was very well received. And we grew the company significantly. I mean, when I joined Benefit Focus in 2012, I think for 2011, the company had revenues of about less than 70 million. And in 2016, their current guidance has them doing about 235 million in this year. And we're still investing.
Yeah.
Okay. So the company, hasn't achieved profitability yet, but there is a clear path to profitability that we had laid out for the street and for the analysts. When I said earlier that there was sort of a bubble building again, there was. I mean, after we went public, there was a bubble building, and we had a valuation that was considerable. As I say, our stock price, we priced our offering at $26.50 a share, and on the first day of trading, we traded at about, I think our high was like 55 for that first day. Our stock traded as high as $70.
Yeah. Where are you and Sean the day you go public? Are you down Wall Street?
Oh yeah, we're at NASDAQ.
And you're just watching it go up, like giving
Yeah,
guys,
so we
giving high fives.
we
to
were there,
everyone?
and you have to know Sean. I mean, it's like Sean and I and our board, and Sean was like, well, we have to take 100 people down to NASDAQ. And we did. Okay, we took 100 associates. We call our employees associates. And we took 100 associates with us down in NASDAQ who were there with us. And then we literally like live screened it back to Charleston.
That's awesome.
And had a big party when Sean and I flew back late that afternoon. And had a big party here in Charleston. But it was a lot of fun. And it's just, Benefit Focus is always kind of Sean's just all about the big show, which is great. It's a lot of fun, and culture is just so important to him. But it was great. We had a great run at Benefit Focus, and it was just time for me, okay, 4.5 years ago, I was like, I'm just going to take some time off when I was leaving Google, and I took 2 weeks off, literally, between jobs. And then it was just time for me to, I started to get to know some people here in the technology community, but at Benefit Focus for 4 years, it was, as you would expect, high growth, 30+% growth every quarter. I was there for 11 reported quarters, and every quarter we grew by more than 30% and beat our guidance. And so it was busy. It was a lot of work. And so I just wanted to it's time. And I talked to Sean and to Mason and our board and said, I'm going to go. And I think we announced it in December of 2015, and I actually left in April of 2016. As I say, I got to know some people in the technology community here, and just wanted to get to know more and do more. Okay? Yeah. So maybe this is where you were.
That's a hell of a first act,
Yeah.
right? You're just getting warmed up. Let me ask you this. So there's several companies I know of, including myself in this group, that have raised capital. I will tell you from my experience, hiring a CFO is nowhere near my radar. I need more engineers. I need them tomorrow. When would you say is the right time to start thinking about hiring a CFO?
Yeah, and that's a great question. I mean, it's not something that you need to run out and do. Okay, first of all, as you would expect, anybody with a C in front of their title is not going to be cheap. Okay, but I think it's also not something that you have to do right away. I mean, I think certainly there's lots of other things that you need to plan for and do in your company, in a startup, that long precede the need to, you got to have somebody that's basically managing your books for you and doing bookkeeping and accounting, and if you're selling a product or sending out invoices and collecting some cash, okay. If you're just developing product, somebody's got to pay the bills and so forth. So I mean, don't rush out and do it. I mean, I think that there are a lot of resources available that I've even gotten to know here in Charleston that you can help. I mean, I've gotten to know in the 4.5 months or so that I've been at Benefit Focus, I've gotten to know a lot of the people in the audience here, and I'm working with some of them. Okay, and that's what I want to do. I'm enjoying doing that. Okay, so find the resources that are available. I've said this before, I mean, this is just a really cool technology community that's emerging here in Charleston. I sort of equate it a little bit to when I first got to Boston in the early 80s, but Boston was more mature in a technology community at the time than Charleston is today. But there's a lot of cool people here, okay, as you know. A lot of you are in this room that are doing really kind of cool things, and I think there's an emerging technology community here that I certainly want to contribute to and watch grow and work with you all in terms of, kind of helping you develop your company. And so that's what I'm doing now. That's what my job is, if you will, now.
I got to ask one more time because I just really want to know the answer as well. Like, literally, when is the right time to start thinking about hiring a CFO? Like Series B, Series C, like 18 months before I'm going public? Should I have done this last week?
I would say you can get past your Series A round, okay, with somebody who's managing your finances for you. I think once you start to get into a B round where it gets a little bit more chunky in terms of size, in terms of, there are angel investors, there are seed capital investors, there are A round investors that they can do a lot of that. They're going to rely a lot on themselves to really kind of understand what's going on in your company. Okay. Then you get into the, as you get chunkier financing rounds, then they're going to, many times, your venture investors, if you will want to put the CFO in there. Yeah. Which, it's happened to me, once or twice, okay, where I was kind of in the case of ITA, I was kind of the venture fund chosen CFO. And it worked out. I mean, I had a great relationship with our CEO and our other management team. But don't let them, pour anything down your throat, if you will. Okay, you want to make sure that you've got a partner. As I said, to me, it was important. I mean, if I was your accounting person, get the title CFO, I want to make sure that we have a very kind of cohesive relationship, like I described, as opposed to just somebody that's coming in and it's like, look, this is the way we're doing it because the people who own a big chunk of your company want it done this way.
Right.
So I think that's the most important thing, is to find somebody. So maybe it's that, and it's going to depend. It's going to depend upon how quickly you're starting to generate revenue, what your business model is. A number of factors are going to go into it, but I would say maybe somewhere in that, when you're getting ready for a B round, you want to have some professional financial talent on board.
That's helpful. Let me flip it. I don't know if you were actually CFO at a company that acquired another company, but I'm sure you have a point of view on this. What are some things that the startups in Charleston can start to do to button themselves up for a smooth M&A process, whether that's Series A or C or later down the road?
Well, I mean, when we talk about an acquisition, are you talking about being acquired?
Acquired, not public, but
or you're just talking about an investment from...
No, being
ventures
acquired.
Being acquired. I guess I know that was one of the questions that you had sent me, and I thought about that question. And my answer to that is, don't run your company strictly to be acquired, okay? Because that's not going to work. I mean, getting acquired sometimes has a very nice outcome, but I don't presume that, in many of your cases, that's the only reason that you're starting at a company, okay? So I think don't try and run it or manage it solely to make yourself attractive to a particular potential acquirer that you think would be a good fit for your company. And I think oftentimes the best acquirer sometimes just comes out of the blue. Okay? It might be somebody that you never even thought about as acquiring a company. So I would say don't run your company to be acquired. But what I would say, in order to just sound practice, okay, is, as I say, things are becoming, it used to be very one-dimensional. Revenue growth was almost the sole metric that investors or sometimes even potential acquirers were looking at. Okay, I mean, obviously your technology has to be something that's, interesting, okay, and desirable by them. But I think that it used to be revenue growth was one of the sole metrics. Today, it's really, do you have a credible business plan? And your business plan needs to include not only how are you going to grow revenues, okay, how are you going to distribute your product, okay, what's your distribution model going to be? Is it going to be a software as a service model, which today has much higher valuation opportunities than, the old perpetual license, annual maintenance contract type of software sale. But also just to make sure that you're building in governance. And governance doesn't have to be complicated. It's checks and balances. It's, do you have an advisory board? Do you have somebody on the outside that's helping you, that's got some experience? I mean, if you could, board of directors is maybe something that's down the road, but just, are you seeking out talent and help, okay, that can help you grow the company and offer you another point of view, something that, well, not so much I've been there and I've done that kind of an attitude, but just, hey, think about it this way, because I've maybe seen it that other way, and maybe you're not seeing it that way. So I think just some built-in governance around, but also, and I don't want to minimize this, I want to say it, the whole notion of making sure that you've got a very defined addressable market, and that 80% of that addressable market. There are probably on one hand the number of companies that have 80% addressable market, captured. What's your addressable market? How are you going to capture a representative amount of that in order to continue to grow? What's it going to cost you to acquire a customer? Customer acquisition cost is a question that I nauseated over. And my board would ask me that so much, like, what's your cost of acquiring a customer? But even like when you kind of back up, it's just the notion of like, how are you going to responsibly grow the company? Not just the top line, but how are you going to ultimately get yourself to profitability? How are you ultimately going to be able to become cash generating, self-sufficient? These are things that when you're a small company, I get it. I mean, I know what you're investing in and what you need, and nobody is going to expect you to take an A round of financing and be profitable, a month later.
Right.
But I think being able to articulate that I'm thinking about it, I have a plan, I have a path to get there is something that people want to hear, and that'll just make it a lot easier, whether you're talking about attracting investors or you're talking about, attracting an acquisition partner. On the acquisition partner side, obviously, as I said, the whole strategic element, it's got to be synergistic from a strategy perspective. What are you doing that's actually going to basically help their offering or make them a bigger, better,
Yeah.
more successful company.
That's an awesome answer. So I'll ask one more question, then we'll open it up. You mentioned a minute ago that you are starting to become more involved in the Charleston and startup community. So can you talk a little bit about what you're looking to give to it or get out of it, and how people in this room could help whatever you're working on?
Yeah, I mean, I just want to get more involved. I mean, through a few people that I got to know earlier on, while I was several years ago when I came to Charleston, and then when I've left, I kind of like reconnected with them and got introduced to a few other people, and it's kind of like you get introduced to two people who introduce you to two people who introduce you to two more people, and that's great, okay? And so then I get an opportunity to spend some time here with you and in front of all you and talk with you. What I'm looking to do now is I just want to become more involved in the technology community. I think I've got to, I've been doing this for a long time. I'm not ready to punch out, okay? I'm not ready to play golf, 5 or 6 days a week. I want to stay involved because I really think it's a really cool place to stay involved. I'm not going anywhere. I mean, when I kind of announced I was doing Benefit Focus, I got a lot of calls from my Boston friends. So you come back to Boston? No. To visit, okay. But I'm staying here, and so I want to get more involved. And there really isn't there's no kind of underlying kind of covert reason. I mean, I just want to be able to kind of work with some of you folks. I already am. I mean, there are people in the room here that I'm already working with and enjoying it, okay, and just kind of getting to know their companies and helping them and offering what I can. You know what I mean? And I just want to stay in the game, I guess.
Yeah.
It's a way to stay in the game, and we'll see where it goes. I mean, it's been, like I said a couple of times when we were just having a beer back there, that I probably quadrupled the number of contacts that I've got in the technology community here now in the last 4 months than what I developed in the first 4 years that I was here, because it was head down and
Sure.
just kind of keeping Benefit Focus being successful. So that's really what I want to do, and I think even as recently as tonight, I mean, I've met a few of you who we'll connect. Okay, we'll get back together, and just, if there's anything I can do, if there's any way that I can help you, whether it's an advisory board capacity or anything like that, I'm more than happy to do it. So
That's awesome. I mean, it's people like you and it's that attitude that makes this community so great. So thank you.
It's a great community, and you guys do a great job. So kudos to you guys.
Thank you. All right, let's open it up with some. All right, we've got time for some questions. Who wants to kick this off?
Yeah.
Mark.
So it looks like the trend for capital markets is going to get tighter. What do we do to prepare for that? And what's your advice to get ready to be a more disciplined, pitcher to VC or private equity?
I mean, I think they're all, whether it's VC, private equity, or even the public markets, I think that there's a, I kind of alluded to it somewhat, tongue-in-cheek, that I think it was in the first quarter of 2014 that, I guess, that there was this bubble building, okay, where I think Benefit Focus took advantage of it by going public in that September of 2013 timeframe. And then in the first quarter of 2014, literally, Janet Yellen made some comments in one of her kind of weekly speeches about profitability of technology companies, and literally you could, it was almost like the next day, if you were an unprofitable software as a service technology software company, your stock, got smacked a little bit, okay? And so I think just the notion, it kind of I think what happened was the market kind of snapped back a little bit, okay? It was sort of getting a little bit heated, a little bit more reliant upon just growth, and that's the most important factor. And then it kind of snapped back, whether it was because of her comments or not. But it just kind of snapped back more into reality, where wait a second, profitability, path to profitability, cash flow generation, those things are still important. And that's what investors are looking for today. Okay, as I say, the earlier stage investor maybe has a more tolerant attitude about when you're going to achieve profitability, when you're going to be able to do this. But certainly, when you get into private equity and then certainly into the public markets, if you're not in the public markets today, there's a line of demarcation even today of public companies that are profitable and not profitable. Okay, and in the case of Benefit Focus, like I say, we were, in my opinion, very, very successful. Okay, we've been a very, very successful company, And Benefit Focus has a tremendous opportunity ahead of them. But we're still in that, we have a path to profitability, which we were very clearly have articulated to the street, but we haven't gotten there yet. So Benefit Focus has said, in the fourth quarter of 2016, the company will achieve EBITDA profitability. Okay? They will achieve EBITDA profitability in the fourth quarter. I mean, it won't be pretty if they don't, I would think. Okay? But I mean, the whole point is, and it's not going to be, they're not going to be able to do it through some bloodbath of expense cutting. I mean, there was a plan that I participated in putting together that would get the company to that profitable state. But I mean, that's what the public investors are looking for today. And I think even the private equity guys and the venture guys are still looking for your ability to articulate how you're going to get there.
Great. Matt?
What are the things that young companies like Ecovate or Atlanta or Good Number 8 should be thinking about from sort of economic trends, political trends, these things that are going to prevent us from either raising money or going public, or what are those things we should be thinking about out there?
Yeah, obviously, the election's going to have something to do with it. Okay, depending upon, you've got an election year, there's always an impact in any election year. Okay, presidential election year certainly. So we'll see how that kind of reality TV show pans out. But I think that I think a lot has to do with what the Fed's going to do with rates. I mean, it seems like the market's been waiting for the Fed to raise rates, and it's always like disappointed every quarter when it doesn't. Okay, and I think it's coming. It's going to come eventually, but I think it's probably going to wait until after the election, okay, before anybody raises interest rates. But that'll have an impact on your ability to raise money. But all of that aside, I still think that for emerging solid technology companies that have a product offering, that have a plan, there's always going to be money out there. There's always going to be venture capital or private equity or seed money or angels or whatever you want to call it that are willing to put money towards good ideas. Okay, and so I wouldn't be afraid. I'd be wary of or just aware of what some of these other external factors, which you really don't have any control over. You don't have any control over whether rates are going up or whether Trump's getting elected or Clinton's getting elected. But I think that there's always money available out there for good ideas. And like I said before, I think being able to really articulate a full plan that includes like how are you getting to market, okay? What are your distribution models going to look like? What's your pricing model going to look like? How are you going to get to a profitable state eventually? How big do you have to be to get there? Where are you going to find talent, okay? That's a question that actually, coming out of Boston, I could have walked out of my office in Cambridge when I was at ITA and thrown a rock and hit like 20 other software companies who were just like us. Now there's lots of talent there. There's also lots of opportunities that are vying for that talent. But here, people would always ask, okay, I would get questions typically from analysts or so forth, Charleston, what's it like to attract talent, particularly technical talent? Nobody seems to care about, financial people. Or you can just wave something in front of them and they'll run down to Charleston. But how do you attract technical talent here? How do you compete with some of the, and I can say that in the 4.5 years I was at Benefit Focus, we really expanded the scope of the geography from which we were able to attract talent. We can now go all the way up to Boston. Okay, the only place we really kind of stayed away from was Northern California, the Bay Area. It's just nuts. Okay, but we're able to attract the talent down here, and I think it's partially because the technology community is beginning to get some visibility. There's a lot of interesting things going on here. It's a great place to live. And I think you've also got in the university level, I think, what's happening very locally with like College of Charleston, and then when you get out to, South Carolina and Clemson and so forth, you've got some really good technology programs that are going there. The whole thing about like South Carolina, like when I first came here, people were like, they'd say Carolina. My son went to the University of North Carolina. Yeah. Okay? So we're big Tar Heel fans. And when people come down here, they say Carolina, and I'm like, well, there's only one Carolina. It's in Chapel Hill. What are you talking about? So when I say Carolina, I mean South Carolina, the school. But there's great programs that are coming out of these colleges and universities that are basically just adding to the talent pool. And then more and more people who have experience, who are more senior, are it's just it's an interesting place to come to, okay, because the technology community is getting some traction now, so. Yeah.
Bouncing off of that, what's the biggest factor to take the tech community in Charleston from the flirtationship that we keep referencing to the marriage? What do you see is going to cause them to stay?
I think it's like, I think like the Benefit Focus story is a great story, okay, and I think you need a few more Benefit Focus stories. And Benefit Focus started in 2000 by, like I say, two guys that ran a pension management, 401k management company, and to their credit, they created a great company, okay, and it's cultural. I mean, culture is literally at the core of Benefit Focus, okay, and Sean Jenkins, our CEO, I mean, I say he, but really we, Benefit Focus, has written 3 culture books already that you can get on their website, okay, they're, Sean might write 20 or 30 pages of forward kind of stuff, and then it's all just individual stories of associates of Benefit Focus. So the whole culture thing is just paramount, developing a culture that people want to come to, that people want to be attracted to. And I think getting a few more like big wins like that, where you get some companies that really start to get some national and even international traction. I think that some of the other companies, we were talking about earlier that have moved to Charleston recently, not just companies like a Blackbaud or a Benefit Focus that have kind of started here, but, Boeing, okay, Volvo's building a huge plant. I mean, what you've got going on up in Greenville with, Michelin's been there for a long time, and, BMW's manufacturing facility up in Spartanburg. I mean, these are technology companies, okay? I mean, they're not just tire manufacturers or car manufacturers, they're technology companies. So I think a few more big wins, though, from some of the people sitting in this room, basically starting a company and bringing it to the point where it continues to get traction, continues to get known, and ultimately then, hopefully, is able to raise money, goes public, gets some traction in that regard. Those are the kind of things I think have to happen. And they will. I mean, I think they'll happen down here. Cool.
What are 2 good reasons to stay private?
2 good? You only want 2? Well, I mean, certainly there's a tremendous amount of expense that goes along with being a public company. Okay, I would say that as a public company CFO, I'd say at least 1/3 of my time, maybe even 40% of my time, was devoted to something that had to do with our company being public. Whether it's dealing with your outside investors and dealing with investment conferences and road shows and things like that, or even raising capital in the public markets, or satisfying your analysts, or dealing with corporate governance requirements. Sarbanes-Oxley and the whole emergence of that over the last 10, 15 years. There's a tremendous cost to doing that, okay? Not just in time, but also in terms of dollars. And so I think that, if you can stay private and raise the necessary capital that you need the way that you want to raise it, and can get your company to profitability, I think that's it's a great thing to do. Okay, so the expense is one. Another reason to stay private is, I think it's just I don't want to say, it's the fact that everything you do is in the light of day. Okay, and there's a fair amount of criticism, okay, that you have to deal with, and it affects everything. It affects your ability to recruit people sometimes. If somebody goes on Glassdoor and writes something negative about your company, all of a sudden you're dealing with that comment for the next 4 months that you're trying to hire engineers. Okay, so I think that the whole notion of you can do things as a private company that are sort of more under the cloak of privacy. Okay, you don't have to be certainly as public at all about what you're doing. So those are 2 things that come to mind. I mean, the expense in terms of time and dollars of being public, and then the notion that you've got to be fully transparent with what you're doing is kind of goes hand in hand with the whole notion of the expense of it. But it's just something that if you can avoid it, there's no, this is not like if you don't go public, you're not successful. I know many companies that are large and privately held. There's one up in Cary, North Carolina, called SAS, that's,
Not too bad.
doesn't do too badly these days,
Yeah.
a private company, so.
All right, we got time for one more question. Michael.
A question on how you see crowdfunding as a alternative source of capital moving forward next 5, 10 years.
It's kind of coming into its own a little bit now. It used to be like, what? Crowdfunding, that's like immoral. I think it's kind of coming into its own. You've got, I think it'll become a way, okay? Personally, do I think it's the best way? No, I don't, okay? But I just think it will become more, I don't know if I want to say mainstream, but just more generally accepted as a way to raise capital. And, there have always been things like that, like ways to raise capital that, like, always people would like, kind of like turn their nose up at. Like back in the day, like, things that were called pipes, okay? Private investments and public equities were like, oh, if you're gonna do a pipe, you're like circling the drain, okay? If you're a public company and you gotta do a pipe, you're circling the drain, just shoot yourself now. But I think it was a way, okay? And I think crowdfunding, I'm not saying it's maybe as bad as pipes, but I think it'll become just one of the generally accepted ways to raise capital. But personally, I don't think it's the best.
Cool. All right, well, thank you for being here.